and then you can go forth and do great things. What I'm sharing with you is my rules, okay? And again, we've seen live, for those of you that have been here for any length of time, when I follow my rules, I'm making money. When I'm not following my rules, I'm losing money. So, the key is to follow the rules that work for you. And these are, what I'm sharing is my rules and some helpful tidbits along the way. I think these things are real important, okay? All right, and then when it comes to scaling, sometimes that whole position, let's see here. Okay, Glenn, let's hold off on that question. We'll go ahead and I think we're going to get to that possibly in another slide or two, okay? The next thing here is, depending on where the 20-period moving averages are on the support resistance levels, it may be more or less than 1 point. I use that example about, pushing in, adding contracts at 1 point intervals, but the reality is, if your entry is here in the downtrend, the hourly chart's in a nice uptrend, okay, it's way up there, you're entering on, let's say, a 5-minute downtrend, but then it goes up. If your next major resistance level is the 15-minute chart, let's say, and it happens to be 2.5 points away, well, that's really more where you might be looking at your entry then, because there's nothing but air between here and there. It could easily go up to that way. So you might want to hold your bullets until you get to that next major resistance level, rather than, okay, it pops up a couple ticks above your moving average, suddenly you're starting to ram contracts back in there again. Well, like I said, you may find it continue to go up to the next level. So this 1 point interval thing is really, it may be more or less than that, depending where the real support or resistance is. And that's what I wanted to make sure you understood. Okay? All right. Now, there's a couple different ways to do this. I said, scaling in a contract, and again, I hate to do this because, people then are just going to assume this is the gospel. You have to do what you're comfortable with, okay? But you can scale one in at the market, for an initial entry. One at the 5-minute moving average. This was kind of written incorrectly here. This should actually be one at the 5-minute 20-period moving average. Is really how that should be written. So my apologies. So what I think I'll do is, let me actually, in the interest of avoiding confusion there, since that was represented there, I want to go ahead and actually, I think we'll put this 5-minute. Okay, I'm just going to go ahead and retype that there to get it right. Obviously, there's a lot of information. As I was going through about 47 pages of information, trying to consolidate it down to some key information there. So this is what it'd be better off to look like. Scaling in one at your initial entry, or putting in one at your initial entry, then maybe another one at the 5-minute 20-period moving average. Okay, and then maybe another one at the 15-minute 20-period moving average. Again, these are with trend only. These are just a couple of ideas. I mentioned and I talked about here that it could also be speed lines, okay? Because if prices move too far away from the 20-period moving averages, sometimes the speed lines will actually act as your real support or resistance levels, and the trades will be taken off of that. In fact, I walked through that with you live just the other day. In a real-life example, as we watched the market pop up to speed lines, the 20-period moving averages were way above, but all the speed lines had a confluence of the speed lines in one particular point, and the market, even though we had accumulation in the background there, according to the VSA principles, we went ahead and we hit my speed lines on multiple time frames all at the same time. Price got there, and despite that accumulation, just rolled over sold off pretty hard. So we went through that example live just a couple of days ago. So it could be the speed lines, but otherwise as guidelines for you to go back and just look and understand the principles of scaling in. Where's that 5-minute 20-period moving average? Where's that 15-minute 20-period moving average? Because people always say, well, where do I scale in? Well, here's a couple places for you to look, okay, in addition to speed lines. Okay? All right. Carl, that depends on how strong. Carl asked, do you ever scale in additional entries in the direction of the trade, okay, like a successful trade? And that depends how many contracts, how much farther I feel that the market could go, and it depends how many contracts I put in initially, okay? Because usually what I'm doing is I'm putting in my initial entry that I feel comfortable with, and then scaling and trailing on the way out of the position. So as the market goes ahead and, like let's say I was going long, okay, and people that have been here with me long enough have gone in and seen me do this kind of thing, okay. So let's say I have, 5 contracts, okay, and here's my entry. What happens is, let's say I go up, let's say a point, and I take 2 off, move my stop up to plus, on the remaining 3 to +1 tick. So the entire trade is what I call a risk-free trade. I'm going to make money on that whole trade. But hopefully what's going to happen is it's going to go up to another level, in this case of probably like 15-minute, 20-period moving averages, and that resistance basically coming down on the market. Then I'll look at going and scaling out even more. So let's say I'll take another 2 off there, move my remaining 1 up here, trying to give it a chance to run, okay? But typically, if you're going ahead, and depending on the nature of the trade, okay, and how strong that hourly trend is, and how much I got off initially. So in other words, if I realize I'm on the right side of the trade, okay, and I got a really strong trend going here, then I may look to actually add on a pullback. So it's popping up, pulling back in the direction of the trend, and I'm looking at the strength of this thing, saying, man, this thing's going to bounce again. Then I may look at adding another one. But I would only want to do that on pullbacks within that trend, Carl. And I rarely end up doing that. Most of the time I end up managing a trade and slowly scaling out and raising my stop. Okay? All right, then, you're welcome. Then with the scaling in, I usually, like I said, when I'm doing it properly, okay, properly from my perspective, that usually involves a pyramiding effect, okay? So if I go ahead and I have multiple resistance levels here, this is, my initial entry is here, let's say, okay, for 1 contract. Then at the first major resistance, I'll be looking at adding 2 contracts, okay? Then in that case, if I have 3 contracts out there, then I'd be looking at adding 3 more contracts here, okay? So that means I got 3 here, 3 here. My cost basis is just a little below the middle line there, okay? Because the first one is here with the increase here. Let's see if we did that right. First one's here. Then I got 2, so that gets my cost basis up to about here. Then I add 3 there. That gets my cost basis up just below the the middle line here. Okay, and then in this case, then there's 6 here. I look at adding 6 there as an example. So it's kind of a pyramiding effect. Again, only in the direction of a strong trend. Okay, if that trend's not strong or that trend is changing on you, you need to look at changing your strategy. aka not scaling in, exiting the position, whatever the case may be. The whole key is there, and you'll see it live as we do it, is to go ahead and focus on having that strong trend, because the market is so much more forgiving I've proven it and I've seen it myself several times. The market is so much more forgiving when you're trading in the direction of a trend. If you trade this when you're trading sideways, sometimes it'll go ahead and work out your way, but as we've also seen, other times the market has the propensity just to turn around and turn all the way back up. And then it may go shoot through here and then come all the way back down, and vice versa. When it's sideways, it can go wherever it wants. So scaling in a sideways market can be very painful, okay? When I've broken that rule, I've lost money generally, okay? I've also made money scaling in sideways, but it's breaking a rule, which is don't scale in sideways, okay? And, for those of you that have, used that rule, scaled in with the trades, in the direction of the trades properly versus here, I've had those reports of great success in, scaling in the direction of the trades, okay? Nobody's really come back to me saying, oh yeah, Rob, I've been scaling in the direction of the trade, waiting for it to rally back up to the resistance levels, doing the scaling, and then, lost a bunch of money. Nobody's sat there and told me that. And I can't think of the last time I did that either, where I had a nice strong trend in my favor, shorted the retracements back to resistance, and then turned around and lost a bunch of money. I can't remember the last time it was. I really can't. Okay? So the markets are more forgiving when you're scaling in the direction of that strong trend. So a lot of this is all based on that concept. If you violate that concept, it can be very ugly. Okay? Now, if entry is too far from the 20-period moving average, remember I used an example like 2 to 3 points away on the S&P, then you got to sit there and say, A, should I even do the trade? B, if I do the trade, even me, Rob Hoffman, is going to go ahead and do it on lighter size. And recognizing that I have bigger stops, it equals more risk, as we talked about earlier. So this is the same thing we mentioned earlier. Okay? So if you're taking an entry, and it's 2 to 3 points away, like on the S&Ps, from the next backup plan, this initial entry isn't going to be 5 or 10 or 15 or 20 contracts. This initial entry is going to be 1, 2, 5 contracts maybe, something like that, because I know I've got a real risk of having to go ahead and ride this thing up for 2 or 3 points against me. That's why I said it's much better to take the trade in the direction of the trend once it pulls back closer to resistance. I've proven that here time and time again. Okay, so keep that in mind. Okay, so failing trades. If you scaled in and it's not working, one thing that I do is take off half at scratch and dump the rest at +1 tick if possible. Okay, so in other words, if I've gotten into a scale in, so let's say I've done one here, so I got one there, 2 here, my cost basis is up here, right around here, and the price moved up to here where I scaled in, and now it's kind of struggling in this area. It's not really shooting right back down and going for the gold and giving me multiple contracts in there, and this thing's starting to go ahead and tank. Okay, it's going into sitting here up here by where I got that second scale in and struggling. Then what I usually look to do is either move my stop up to break even, which means I lose commission, or I do it down 1 tick below, okay, if I see the opportunity for there, which is what I often do, and I get the +1 tick so that I make commission plus money on each of my trades. And with the S&Ps, of course, S&Ps are a little bit more generous as it relates to commissions than, say, the currencies are, okay? So, but that's what I'm talking about is, in other words, an entry where I get an initial entry, and then I have to do a scale in, and then even after the scale in, the market's not cooperating and going back the direction that I thought it was going to go. It goes ahead and struggles up here near my area of entry. Then I'll look to just go ahead and scratch that for +1 tick or even break even. Okay? Sam, can I explain that another way? Okay, let me draw a 5-minute moving average a 20 period moving, a 15 minute, these are 20 period moving averages, a 5 minute and a 15 minute, okay? And I do my initial entry here, okay? So I just shorted here, okay? But turns out I don't have a backup to this trade until here, okay? So I hit it. I see it's got a lot of resistance here. Maybe it has some speed lines, has the 20 period moving average. So I go ahead and I scale in then here. So here I have one contract. Here I put two more contracts in. My cost basis is not zero, or it's not. My cost basis isn't here. It's not at the 50% level from here to here. It's going to be slightly above that. Okay, so cost basis would be roughly here, let's say. All right, so that's where my cost basis is, Sam. That's where I've got to get below that point to start making money. Okay, this point now, not here, not here. I got to get below this point here because I've got three contracts in, two of them at the higher point, one of them at the lower point. Okay, so here's where my cost basis is. Now, what I'm expecting to have happen is what was supposed to happen originally because the market's in a strong downtrend. I'm expecting this thing to hit this and roll over and die. If I go ahead and I get into this trade, the second scale in here, and it doesn't go ahead and roll over, it just kind of pulls back a little bit, but starts kind of hanging near my scale in point. So I'm basically break even, plus one tick, minus a tick. It's just kind of basically hanging around my initial entry, or my second entry here. So my average price, it's not going down like I want it to, then I'll just exit the trade. And Sam, you've actually been here long enough where I've done that in front of you. You know, basically, I get into the trade. I expect that after I do my scale in and raise my cost average to the next level, so I raise it up to about here, I'm expecting the price to turn right back down and go down. Okay? If it doesn't, then what I'll do is either get out right at break even and lose commission, or get out at plus one tick as it's meandering back and forth in this area, kind of consolidating, hitting my level, going a little bit below it, going a little bit above it, meandering. Well, my concern is if it does that too long, it might be getting ready to actually, it's building a base here. It might actually be getting ready to go to the 30-minute 20-period moving average. So I don't want to see this build a base. If I'm going and scaling into it in the direction of the trend, I want it to start working and go my way. So if it just trades sideways around my price where I'm hanging there with plus one tick profit, break even, down one tick, so on and so forth, that's not what I expected to have happen. So what I'll do is I'll get out with like a plus one tick profit. Or if it just won't come down to that level because it's so strong, it's holding even above that, then I'll look at getting out like at scratch. Okay? So when the 20-period moving average goes flat, get out. It can start going either way. Okay? So in other words, if you initially entered that trade in good faith because it was a nice downtrend, and this happens every once in a while, where does this happen? This usually happens when you go ahead, you get into a trade, and it's not working as fast as you want it to. It's not going against you per se, but it's just not going as fast as you want to. So let's say you end up getting into it right here. Well, the price isn't going anywhere. It's just going ahead and basically trading sideways as time is going along. Well, what happens is eventually that moving average will come up to meet it and start to flatten out. If that happens, you're in trouble, okay? Because then you have the risk of it going to the upside. And like I said, this has nothing to do with scaling. This is just talking about when trades go bad, okay? Let me be clear. Whether you're scaled in or not, this is the same issue. Time is not your friend when it comes to moving averages. And I've talked about that and explained that many times. Time is not your friend when it comes to moving averages. You know, because the moving averages, you know, just like initially when a move starts to happen, the 5-minute, the 15-minute, the 30-minute, and the hourlies are all very close to each other, giving you a superior support resistance level when they're all kind of very close together if it bounces back up there. But over time, the 5-minute will peel down to here, the 15 will be to here, the 30-minute will be to here, the hourly may be up to here, and so they're so spread out, it means it may take more scaling, assuming a strong trend. So time is not your friend. Time is also not your friend if you're in a trade and like I said, it's basically the price is catching up, or the moving average, each 5-minute bar or hourly bar, whatever it may be, the price doesn't, it goes up a little bit, goes down a little bit, but ultimately it's very near your initial entry price here, just kind of meandering. It's not doing what you expected it to do, and these moving averages are coming down. Well, once they hit, they're going to start to flatten out. That's, kind of a big fat, exit sign from my perspective. Okay? So a couple other things you can keep in mind that if like you're above the 20 period moving average on the 5-minute chart and it closes below it, that could be a sign that, depending on, what kind of trade you're doing. If it's like a scalping trade, for instance, Glenn, this applies to you as far as, the educational opportunity. You see if this meets your risk trading plan and stuff like that, okay? I can't advise you how to trade, all right? But I'm just saying, since you're interested in the scalping, I wanted to go ahead and just let you know that, this is one of the things I'm talking about for there. So let's say I got the speed lines here, and I got the 20-period moving average here, and we're doing a scalping trade, Sam, okay? I'm sorry, Glenn. So we're doing a scalp trade. Let's say we go long right here, all right? Expecting it, price has been meandering around. It's coming down here. We're expecting it to pop back off. If it doesn't, and it turns around and closes back down below here, that could be another sign that you're in trouble. Now, if you're in a really strong uptrend, could you maybe find that as an opportunity to scale in more? Yeah. But if your whole mode of operation is just for a quick scalp, then you may not be wanting to turn a scalp trade into a big scaling position, okay? Because you got to ask yourself, why were you scalping in the first place versus doing a positional trade if you had that much comfort in the trade itself? Does that make sense, everybody? So if you're going into it with the intention of scalping, there must have been something that didn't make you real happy when you initially analyzed it to do a big position trade, okay? So you're sitting there looking for the short-term gains. You're going to take a couple, 2, 5 ticks, whatever it may be, 10 ticks out of this thing. But then all of a sudden, it starts pulling back, and now suddenly it's kind of like this. I remember this very well from the 90s. I remember these people I was in these chat rooms with, just hanging out with them, trying to help them, because I'd already had a lot of success. I was very happy, and I was just helping people for free in public chat rooms. And I'll never forget the people that would go ahead and turn day trades in stocks into what? Long-term holdings. Because what they would do, they would talk themselves into holding it. So let's say, Apple. They're taking Apple for a short-term intraday, long position, okay? But then all of a sudden, by the end of the day, something happens and Apple's down significantly. Rather than going in and getting out of their position, what they would do is they'd come up and say, Rob, here's 10 different reasons why I'm going to now hold on to Apple. I was only going to go ahead and scalp it for a couple of pennies, a couple of eighths at the time, back when the market was still trading in eighths, I was going to go in there for a quarter or 3/8 or a half, dollar. And, well, gosh, it's down against me now, $2. But you know what? I'm going to hold this because Apple's supposed to report really good earnings in a couple weeks. Apple's got a new product coming out soon. So they turned a day trade into a long-term holding or even a swing trade holding, okay, for all the wrong reasons. okay? And so they justified, they explained why they were going to go ahead and stay with a bad trade, okay? So it's the same thing here. Glenn and everybody else who's looking at scalping, ask yourself, if you're looking at scalping, like in doing one of the trades I'll show you from a scalping perspective, why then are you going to turn the scalp that's supposed to go up here into a big position down here? If it was that great, maybe you should have been thinking positionally right off the bat. But if you didn't think positionally off the bat, what was it about it that kept you from thinking positionally? Does that make sense? So don't talk yourself into holding the trade longer in the future. Okay, good. I'm seeing a lot of yeses there, so at least I know that many people got it. So just, very important stuff. Okay, so that's what I'm talking about. Like in a case like a scalp, if it closes below the 20-period moving average, that's usually a sign for me on my scalps that something's wrong. Okay, so close above or below, depending on the side of the trade you're on. Okay, a close above or the 15-minute chart. It could be the same thing on a TC20 trade. For those of you that are familiar with my TC20 trade, what am I looking for? Looking for the price to come down. I'm looking for us to go ahead and rally up to the 15-minute chart. Ideally, that's where that trade was born, off of the 15-minute charts. Does it work with 5-minute, 30-minute, and hourly charts? Yes, it does and can. But the reality is, for those of you that don't understand this about me, I actually went ahead and, I used to just trade off like 15-minute charts and higher. Really, I did the execution off 15-minute charts. 5-minute charts got added because of all the volatility in the last, year and a half. Okay, so I had to tighten up my executions because I was doing more, equivalent scalping because of the, unprecedented volatility in these markets. Okay, and for those of you that were here watching me do 50, 100, 150 contract trades, even for a tick or two, you saw that added up very quickly when you guys were watching me do those trades. Okay, some great stuff. So the point being then, I go ahead and I'm expecting this market to be coming down, having a rally back up here, hitting this level, and I'm expecting it to roll back down, right? Remember, I want the thrust up to this level and it to roll back over after I go short. If I go ahead and all of a sudden I'm in this trade and it turns around and starts closing above this 15-minute chart, well, that's a problem. Okay, that's a real problem because that's not what I expected to have happen. What I expected to have happen was it hits my resistance and rolls over.